Most people think the hardest milestone in building wealth is reaching your first $1 million. It sounds logical. It's the number everyone talks about. It's the number financial headlines celebrate. But what if I told you that, for many people, the most valuable money they'll ever earn isn't their first million at all? It's their second $100,000. Meet Ryan and Daniel. Meet Ryan. They both live in Denver, Colorado. They both earn $95,000 a year before taxes. They each have exactly $100,000 invested in a low-cost S&P 500 index fund and another $25,000 sitting in an emergency fund. Same job market, same housing costs, same salary, same starting investments. If one ends up dramatically wealthier than the other, it won't be because life handed one of them better cards. It'll be because of one decision. Ryan reaches his first $100,000 in investments and decides he's finally earned the right to enjoy the rewards. He cuts his investing in half, starts spending more of every raise, upgrades his vacations, and tells himself that the hard part is over. Daniel reaches exactly the same milestone and comes to the opposite conclusion. He decides the first $100,000 was just the engine starting. Instead of slowing down, he increases his monthly investment by another $300 whenever he gets a meaningful raise. Both of them think they made the smarter choice. They're both wrong. Because the biggest surprise isn't who becomes richer. The biggest surprise is why the second $100,000 ends up being worth more than the first million in ways almost nobody talks about. And when you see the math behind it, the gap between these two ordinary workers becomes almost impossible to ignore. Here's the mistake. People think wealth grows in straight lines. Work harder, save more, reach another milestone, repeat. But money doesn't work that way. Money compounds, and compound growth changes the importance of every dollar depending on when it arrives. The first $100,000 is difficult because almost every dollar comes directly from your paycheck. You're fighting taxes, rent or mortgage payments, groceries, insurance, student loans, childcare, and everything else life throws at you. The second $100,000 is different. By then, your money has started working alongside you. Eventually, if you keep investing, your investments begin producing more annual growth than your paycheck contributes. That's the point where wealth starts feeling almost unfair. But getting there depends on what you do immediately after reaching that first six-figure milestone. Let's look at Ryan and Daniel. Both have exactly $100,000 invested in a diversified S&P 500 index fund with an annual expense ratio of just 0.03%. Roughly in line with funds offered by providers like Vanguard and Fidelity. Historically, the S&P 500 has returned about 10% annually before inflation over long periods, although returns vary significantly from year to year. That's not a promise. It's simply what decades of market history have shown. Both continue receiving modest 3% annual salary increases. Ryan decides that investing $500 per month feels good enough. After all, he already proved he could reach six figures. Daniel looks at the exact same account balance and makes a different calculation. He increases his monthly contribution to $1,200. That's a difference of $700 every month. On paper, it doesn't sound life-changing. $700. That's one nice car payment, a few restaurant dinners, and a vacation fund. Feelings and math are two very different things. Ryan's decision feels exciting because he finally gets to enjoy more of his income today. Daniel's decision feels almost invisible. Nobody congratulates you for increasing an automatic transfer. Nobody notices another purchase of an index fund. Nobody on social media posts screenshots of their boring monthly contribution. But compound interest notices. Now let's fast forward 1 year. Ryan begins with $100,000. Assuming an 8% annual market return during that year, his investments grow by roughly $8,000. He adds another $6,000 through his monthly contributions. His ending balance is approximately $114,000 before small fund expenses. Daniel starts with exactly the same $100,000. His investments also earn about $8,000 from market growth. But instead of contributing $6,000, he invests $14,400 over the year. His ending balance reaches roughly $122,400. The gap after 1 year? Only about $8,400. That's hardly enough to make anyone rethink their financial strategy. Ryan looks at Daniel's account and shrugs. I'll catch up later. That's what almost everyone says. But here's the problem. Compound growth doesn't wait. Year 3 starts looking different. Ryan has continued investing $500 every month while earning average market returns. His balance grows to approximately $145,000. Daniel, investing $1,200 every month under the same market conditions, reaches roughly $172,000. Now, the difference isn't just the extra contributions. Daniel's investment gains themselves are becoming larger because they're being earned on a larger balance. His money is earning money. Then that new money starts earning money too. This is the part people understand intellectually but rarely feel emotionally. Every additional dollar invested early becomes another employee working for you forever. Ignore one employee. No big deal. Ignore hundreds of them over 20 years. That's an entirely different outcome. Now let's reach year 5. Ryan's account grows to approximately $179,000. Daniel crosses roughly $226,000. The difference is approaching $47,000. On paper, that's impressive. Sounds great until you subtract something almost nobody includes: inflation. According to long-term data from the U.S. Bureau of Labor Statistics, inflation steadily reduces purchasing power over time. If inflation averages around 2.5% annually, some of those gains simply maintain buying power rather than creating new wealth. Both investors face that reality equally, but because Daniel owns more appreciating assets, inflation hurts him less in relative terms. More of his net worth remains invested in businesses that have historically raised prices and earnings over time. Ryan isn't losing money, he's losing momentum. Momentum is invisible until it isn't. Here's where things become even more interesting. People love celebrating the first million because it's a clean, round number. They imagine that once someone becomes a millionaire, everything changes overnight. In reality, something much more important often happens much earlier. Around the time your investments grow beyond $200,000 or $300,000, depending on market performance, your annual investment gains begin looking surprisingly similar to what you're personally contributing from your paycheck. Imagine your portfolio earns 10% in a strong year. A $250,000 portfolio could generate roughly $25,000. That's more than many people save in an entire year. Think about what just happened. You still went to work. You still earned your salary. But another source of wealth quietly appeared beside it. No overtime, no second job, no promotion, just ownership. Ryan is getting closer to that point. Daniel gets there years earlier. And that timing difference turns out to be one of the most expensive financial decisions most people never realize they're making. Because from this point forward, the game slowly changes from "how much can I save" to "how much can my money earn without me?" And that's exactly where the second $100,000 begins to matter more than the first million. The reason isn't emotional, it's mathematical. And once we extend this comparison to years 10 and 20, while accounting for taxes, sequence of returns, opportunity costs, and the hidden numbers almost everyone ignores, the outcome becomes far more surprising than either Ryan or Daniel expected by year 10. Ryan feels pretty good about where he stands. His salary has climbed with annual raises to just over $124,000. His retirement account statements are getting bigger every year. Friends know he's good with money. He owns investments worth roughly $307,000, assuming an average annual return of 8% and his continued $500 monthly contributions. Crossing $300,000 feels like a major accomplishment. And it is. But Daniel has quietly crossed approximately $418,000. That's a difference of more than $110,000. What's fascinating is that Ryan doesn't think he's behind. From his perspective, both of them are doing well. Both avoided debt, both invested, both stayed disciplined. The difference feels small because neither one is comparing annual investment income. They're only comparing account balances. And those tell a very incomplete story. Let's look underneath the surface. Ryan's $307,000 portfolio, growing at 8%, produces about $24,500 during the year. Daniel's $418,000 portfolio grows by roughly $33,400. That's nearly $9,000 more. Notice something. Daniel didn't work extra hours to earn that additional $9,000. He didn't negotiate another promotion. He didn't launch a side business. His investment simply produced more because there were more dollars invested. That's the first flip point. The extra monthly contributions no longer explain most of the gap. Now the portfolio itself is creating the gap. This is where compound interest stops looking like a financial concept and starts behaving like a second paycheck. And every year after this, that second paycheck gets larger. Now let's push forward another decade. Year 20. Ryan is 55 years old. Daniel is 55 years old. Same city, same career, same salary history. Neither inherited money, neither picked individual stocks, neither got lucky buying cryptocurrency at exactly the right time. The only meaningful difference happened 20 years earlier, when one man treated his first $100,000 as a finish line, while the other treated it as the starting line. Ryan's portfolio has grown to approximately $760,000. That's an incredible achievement. Most households never reach that level of invested assets. Daniel, meanwhile, has accumulated roughly $15 million. That's almost a $390,000 difference. Now ask yourself something. Did Daniel contribute $390,000 more out of pocket? No. His higher monthly investments explain part of the difference, but a much larger portion comes from the returns earned on previous returns. That's the snowball effect everyone talks about. Very few people ever calculate it. Here's another way to see it. During year 20 alone, Ryan's investments earn roughly $61,000 at an 8% return. Daniel's investments earn approximately $92,000. That's over $30,000 of additional growth in 1 year, without changing jobs, without asking for a raise, without adding extra working hours. That's why your second $100,000 becomes so powerful. It accelerates the arrival of every milestone that follows. Now, before anyone says, well, that's assuming the market goes up every year, let's address something important. Markets don't move in straight lines. Some years they'll fall 20%. Other years they'll gain more than 25%. According to long-term data published by Standard & Poor's and historical market research, large declines have always been part of investing. The difference is that disciplined investors continue buying during both good years and bad years. In fact, bear markets often become the years that produce the highest long-term returns because every monthly contribution purchases more shares at lower prices. Ryan continues investing. Daniel continues investing. Neither one tries to predict the market. But Daniel purchases substantially more shares during every downturn because his contribution remains higher. When markets eventually recover, as they historically have over long periods, those additional shares magnify future gains. Again, the second $100,000 isn't valuable because of the number itself. It's valuable because of what it allows your investments to start doing. Now let's talk about something almost nobody includes when they tell these success stories. Taxes. If these investments sit inside a traditional 401k, taxes are generally deferred until withdrawal under current IRS rules. If they're held inside a Roth IRA, qualified withdrawals can be tax-free, assuming IRS requirements are met. If they're invested in a taxable brokerage account, dividends and capital gains may create annual tax obligations depending on income and holding periods. Those differences matter a lot. Suppose both Ryan and Daniel invest through taxable accounts. The S&P 500 currently produces a dividend yield that's typically around 1% to 5%, although it changes over time. Qualified dividends may receive favorable federal tax treatment compared to ordinary income for many investors. That's a benefit. But selling appreciated investments may trigger capital gains taxes. That's a cost. On paper, Daniel's portfolio earned about $92,000 during year 20. Sounds fantastic until you remember that eventually, depending on where the money sits and how it's withdrawn, part of those gains may belong to the IRS. That's why account location matters almost as much as investment selection. Then there are fund expenses. People often ignore expense ratios because they're tiny. An index fund charging 0.03% annually barely registers. An actively managed mutual fund charging 1% sounds harmless, until you compare them over decades. A difference of roughly 1% per year compounded over 20 or 30 years can reduce ending wealth by hundreds of thousands of dollars on a seven-figure portfolio. 1 percentage point. That's it. Tiny annual costs become enormous lifetime costs. It's another reminder that wealth isn't usually lost through dramatic mistakes. It's often lost through small numbers repeated thousands of times. And speaking of hidden numbers, there's one topic almost every financial influencer skips because it doesn't make flashy thumbnails. Opportunity cost. Ryan enjoyed more vacations, nicer restaurants, a newer SUV, better season tickets. None of those purchases were necessarily bad decisions, but every dollar spent today also carries an invisible price tag, not just the purchase price. The future value of what that dollar could have become if invested instead. A $700 monthly difference invested over 20 years at an average 8% annual return doesn't just equal the contributions. It becomes hundreds of thousands of dollars because every contribution has years to compound. That's opportunity cost. Not punishment, not guilt. Just math. And math doesn't care whether the spending felt justified at the time. It simply records what happened. This is also where many people misunderstand what becoming a millionaire actually feels like. They imagine reaching $1 million suddenly changes their financial life. In reality, someone with a $1 million portfolio earning 8% could experience roughly $80,000 of annual market growth in a strong year. Some years much less, some years negative, but that's the point. The portfolio begins generating amounts that rival full-time salaries. That's why getting to your second $100,000 faster matters so much. It shortens the time until your investments become meaningful contributors to your overall wealth instead of depending almost entirely on your paycheck. But if I only showed you the advantages of investing more, I'd be doing exactly what too many finance influencers do. Because Daniel's strategy has real downsides too. And those downsides deserve just as much attention as the upside. Daniel's approach sounds almost perfect so far. Invest more. Reach every milestone sooner. Let compound growth do the heavy lifting. If I stopped the comparison right there, I'd be telling you only half the story. And half the story is how bad financial advice spreads. Because investing aggressively has real trade-offs. The first one is volatility. Ryan's smaller portfolio is worth about $760,000 after 20 years. Daniel's is around $1. $15 million. Now imagine the market falls 25%. Ryan watches his account decline by roughly $190,000. Painful. Daniel watches nearly $288,000 disappear on paper. That's almost a $100,000 larger decline in a matter of months. Nothing about his strategy changed. Nothing about the companies he owns necessarily changed. Only market prices changed. Emotionally, that's much harder to live through. The second downside is liquidity. Daniel has been directing an extra $700 every month toward long-term investing. Over 20 years, that's $168,000 of additional contributions before investment gains. That money wasn't available for spontaneous opportunities. Maybe a business opportunity appears. Maybe real estate prices suddenly collapse. Maybe a family emergency requires significant cash beyond an emergency fund. Investments can be sold, of course, but selling during a bear market may lock in losses or create taxes. Liquidity has value. It's just difficult to measure until you suddenly need it. Third comes sequence of returns risk. This one sounds technical, but it's actually simple. Imagine Ryan and Daniel both retire the same week. If the market falls 30% during their first retirement year, withdrawing money becomes much harder because they're selling investments after they've declined. This is one reason many financial planners recommend gradually increasing cash or short-term treasury holdings as retirement approaches. The larger your portfolio becomes, the more important risk management becomes. Growing wealth and protecting wealth are two different skills. Finally, there's lifestyle. Ryan wasn't wrong for enjoying some of his income. Money exists to improve life, not simply to create the largest spreadsheet possible. If investing more means sacrificing experiences you'll never get back, that's a real cost too. The goal isn't to die with the highest account balance. The goal is to use money intentionally. So when does Ryan's approach actually win? More often than you might think. Suppose Ryan uses part of that extra monthly cash to eliminate credit card debt charging 22% interest. Paying off guaranteed 22% interest almost certainly beats hoping for an average 8% market return. That's not even a close comparison. Or, imagine Ryan's employer doesn't offer a retirement match, but he uses the extra money to build a profitable small business earning consistent double-digit returns. That business could dramatically outperform index investing. Different assets, different risks, potentially different rewards. Here's another scenario. Suppose Ryan buys additional education that increases his annual income by $20,000. If that higher salary allows him to invest significantly more later, the temporary reduction in investing could produce a better lifetime outcome. Human capital matters too. Then there's housing. Imagine home prices temporarily decline while mortgage rates fall. Ryan has more accessible cash available for a substantial down payment. If he purchases a property at an unusually attractive valuation and lives there for many years, that decision could outperform simply increasing monthly index fund contributions. Again, context matters. The winning strategy depends on the numbers, not the headlines, not social media, not whichever financial personality happens to be trending this week. Now let's talk about the number almost everyone brags about, net worth. I just crossed $1 million. Sounds impressive, and it is. But net worth by itself tells you almost nothing, because there are layers underneath that headline number. Let's peel them back. First, taxes. A traditional retirement account worth $1 million isn't necessarily worth $1 million after future taxes. Depending on future tax rates and withdrawal strategies, part of that balance belongs to the government. The IRS publishes required distribution rules and tax treatment for retirement accounts because those obligations are real, not hypothetical. Second, inflation. If inflation averages just 2.5% over 20 years, $1 loses a meaningful amount of purchasing power. That means $1 million 20 years from now won't buy what $1 million buys today. Nominal wealth and real wealth are different things. Third, investment costs. Even low fees matter. Suppose investor A pays an annual expense ratio of 0.03%. Investor B pays 0.90%. On a seven-figure portfolio, that difference compounds into tens or even hundreds of thousands of dollars over time. It's invisible because nobody writes a check for it. The money simply never appears. Fourth, behavior. This is the hidden cost almost nobody can calculate. Research from Dalbar has repeatedly shown that many investors underperform the funds they invest in because they buy after markets rise and sell after markets fall. The investment isn't necessarily the problem. The timing is. Behavior creates its own expense ratio, except it's measured in bad decisions instead of management fees. Fifth, opportunity cost. Every dollar has an alternative use. Spend $5,000 today, and the cost isn't only $5,000. It's whatever that money could reasonably have become over the next 20 or 30 years. Again, not guilt, not judgment, just arithmetic. And here's something fascinating. According to the Federal Reserve's survey of consumer finances, relatively few households accumulate substantial investment portfolios before retirement age. That's not because most people lack intelligence. It's because consistent investing over decades is psychologically difficult. The math is surprisingly simple. The behavior isn't. So if you're trying to apply this to your own financial life, here's a practical framework. Step 1. Treat your first $100,000 as the beginning, not the finish line. Reaching six figures proves your system works. Don't slow down at the exact moment compound growth is beginning to help. Step 2. Automate every increase. Whenever your salary rises, increase your investment contribution before your lifestyle expands. If your raise adds $500 per month after taxes, direct at least part of it straight into investments before you become accustomed to spending it. You won't miss money you never learned to live on. Step 3. Keep investment costs low. Whether it's an index fund, a retirement plan, or another diversified investment strategy, pay close attention to expense ratios and unnecessary fees. Saving 1 percentage point every year may not sound exciting. 20 years later, it becomes one of the highest-paying financial decisions you'll ever make. Now let's return to Ryan and Daniel. 20 years ago, both men walked away believing they'd made the smart play. Ryan believed he'd earned the right to enjoy more of his paycheck after reaching his first $100,000. Daniel believed the smartest move was to keep pressing forward while compound growth was finally beginning to work in his favor. Neither one was completely right. Neither one was completely wrong. Because the real lesson was never about choosing happiness versus investing. It was about understanding the full math before making either decision. Ryan never calculated what reducing his contributions would cost 20 years later. Daniel never fully appreciated the emotional challenge of watching a seven-figure portfolio lose hundreds of thousands of dollars during a market crash. They each focused on one part of the equation. Neither started with the entire equation. And that's the real trap. The real trap isn't spending money. The real trap isn't investing money. The real trap is making financial decisions based on hype, headlines, milestone numbers, or someone else's opinion instead of running the numbers for your own situation. Because when you finally do, you realize something surprising. Your first million may be the milestone everyone celebrates, But your second $100,000 might be the moment that quietly determines whether you ever get there in the first place. And if you're wondering what happens when someone reaches their first million and then completely changes how they invest, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.